Hello, hello. My name's Greg Bettinelli. I'm a partner here at Upfront, here with Laela Sturdy.
Hi, everyone.
So Laela, I really appreciate you being here. We have about 20 minutes and excited to have a conversation. I have a whole notepad here so we can go all day, but I wanted to just take a step back and just give us the lay of the land in regards to how Alphabet thinks about venture, private market investing, your business, others, just to kind of get us all level set it on how it works.
Yeah, absolutely. So actually, investing was a big part of the reason the Alphabet structure was set up many years ago. So it actually came from Larry and Sergey and some of the board and senior Google people from way back in the day. And they were thinking about what are the ways that Google, Alphabet can use their resources, their people, money, infrastructure to help build the next great technology companies. And the idea was some of those companies would be built inside of the Alphabet family as part of Google or separate business units. And the idea was also that we could build out robust investing arms that could help invest in and then partner with the next generation of startups that can work in different industries and can take advantage of some of the, not just capital from Google and Alphabet, but other resources, advisors, people. So that is why you see within Alphabet, there's a pretty significant commitment to investing. We have several different funds. There's GV, Gradient. Alphabet makes investments off the balance sheet. And then there's a fund where I'm a general partner, which is CapitalG, and we're focused on growth investing. So all of these different funds were set up because we believe there's different disciplines and different capabilities associated with different stages of investing, different mandates, but all were involved in just this broader commitment to supporting the startup ecosystem and helping create the next generational companies.
So 4 different entities within Alphabet.
Yeah.
Just, you can share what you can share. How many people work, you think, in those 4 entities? And then what does the size look like for CapitalG?
Yeah, so with CapitalG, we have about 40 people. We invest about $1 billion a year in, as I said, growth stage companies. Probably within the various other investment arms, there's 100, 200 people overall. So as we know, investing arms, compared to the overall scale of the number of people that work at Alphabet, relatively small number of people, but managing a pretty significant amount of capital.
And if you dig in a little bit, or double click, I should say, on CapitalG, are most of the 40 people come from Google and Alphabet over time? Like you were at Alphabet for a long period of time before. Does that tend to be the migration? Or
yeah, so not really. That was sort of an interesting, and when we were getting CapitalG started, we had one of the founding principles on starting CapitalG was that we really wanted to build a diverse team. And so our initial 3 general partners, as Greg mentioned, I had spent my entire career on the operating side, so I had never invested before. This was about 8.5 years ago. My other partner who started the fund, David Lowy, had run corporate development at Google for a number of years, had run marketing at Google before that. And then our third partner had been at TPG for a couple decades. So we brought together a very diverse set of operational and investing skill sets. And we thought that was, and I really do believe that was foundational, especially in the early years of getting CapitalG off the ground, of really building the discipline of our investment committee. TPG had a pretty robust set of diligence processes and analytical capabilities that Gene could bring to bear and sort of training up our team and thinking through our investment committee. I had a lot of experience. I'd helped start a couple different businesses within Google, and David had his operating experience as well. So in the early days, we were really focused on how do we build the most diverse team that we can to support entrepreneurs at the growth stage. And we sort of knew we had the advantage of having the Google brand and Google as an LP, but we had to build our reputation as investors, and we had to build our portfolio from scratch. So we were committed to being, the most helpful partners we could. And we felt like building that diverse team was a really important part of it. So over time, as we've been around now 8 or 9 years, I'd say we still really try to bring operators and entrepreneurs and help teach them the craft of investing the same way that I learned it, and believe that that's really important, especially in the growth stage, because the sort of empathy you need and experience of supporting entrepreneurs, if you've had operating experience, I think it can be really helpful. But you also need a lot of discipline. I mean, the diligence process and how you underwrite investments when you're investing $100 million or $200 million in a company is pretty significant. So you need that set of skills as well.
She was taking a picture of my shoes.
Excellent. Let us know if for Greg's wife,
that was very awkward.
Point, but
so what's the how would you sell me on the CapitalG secret sauce? Like why, and we'll get to where the markets are going.
Are you starting a company? Because I mean,
all VCs want to be operators, and all operators want to be VCs.
There you go.
Like,
I love it.
No.
Yeah. So the secret sauce. So what's different about us is that Google and Alphabet are a single LP. So lovely to meet all the LPs in the room. I only talk to one right now, which is fun. But what we do is we're an independent investment fund. So as the general partners, we have the same incentives that any other independent investment fund would have. We have decision-making authority on our investments. But the advantage is we have a really flexible holding period because Alphabet's very patient capital. And we also have a network of 100,000 people that work at Google and Alphabet that engage with our companies and help support our companies in a lot of really interesting ways. So there's all sorts of examples we could share about that. But for example, we have tons of cybersecurity investments where we have longtime Googlers in cybersecurity that work as advisors to our fund. We have deep partnerships with Google Cloud who help on the go-to-market side. We have, as you can imagine, Google knows a thing or two about marketing and scaling marketing and sales channels. So we found that there's just a really deep talent pool within Google who I always joke, they're paid too well to leave and they still believe Google's a startup in many ways, even though we all know it's far from that. But they have a lot of entrepreneurial energy and a desire to help bring their expertise, whatever it could be, optimizing AdWords campaigns or building data infrastructure, data science, and we bring them as advisors and sort of free sweat equity to our companies. And we have found that being able to organize that labor force, lots of people, other venture funds build that within their team, but that can only go so far. Some are pushing the limits of how far that can go. We find it that it's been a really scalable model to hire operations folks on our team who help organize that sort of specialized labor, for lack of a better word. And it's been really fun on all sides because I feel like we've also really been able to give back to people that work at Google who are looking to develop skills, learn more about the ecosystem outside of the mothership. And our companies have loved it. So it's been a really fun, it was a thesis when we started it out, and then it's been a really rewarding thing to build over the last 8 or 9 years.
And what's Laela Sturdy's area of expertise and focus? When you look at today's market, even yesteryear or looking forward, what do you like to spend your time?
So what I love about investing is that I love the chance to learn new things, and the way that I've kind of managed my whole career, why I loved Google, honestly, and why when people ask me, what company should you join? I'm like, join growth stage companies, because companies that are growing 100% year on year, they'll always let you do new things. So, when I was working at Google, when we acquired YouTube, and I ended up, some of my old YouTube friends and in the audience that we were chatting earlier, got to manage a sales team. I'd never sold anything in my life. It just, helped launch AdWords Express, which is a new product for Google way back in the day, and I'd never served SMB customers. So my whole operating career, I loved learning new things, and I've treated investing in the same way. I kind of spend 18 or 24 months going deep in different areas. So when I first transitioned to investing, I did a lot of consumer and SMB, and then I moved into sort of fintech and enterprise, and then everyone else moved into enterprise. So I moved back into consumer and e-commerce when I thought prices got really crazy. So we do very deep thesis work at CapitalG. We spend months researching companies, talking to customers. I was joking with someone in the hallway because they were asking me how we got into our most recent deal. And he said to me, people are asking me how you guys got in. And I said, what did you tell them? And he said, I told him the truth, your deck. Which is like, wow, my slides are still getting me deals. But that's what we're proud about.
You were a consultant in the old days.
Yeah, a consultant back in the day. No, but it's the deep work that is the privilege of investing, is that you get to really spend your time thinking about things and doing deep work. And so I move around, but in kind of 1.5 to 2 year increments.
Well, it does feel there is a narrative that, and we'll talk about the Tigers and D1s of the world in a little bit, but that a narrative that some of these growth funds are far more prepared when speaking with founders and even boards than anyone who was there before them. Yeah. And it turns out that the level of diligence and experience wins over not just price and terms, but also this knowledge and understanding, insights from competitive, where you learn, when a founder or a team learns something from an investor, it's remembered. And I don't feel that's done. I think, CapitalG is an example of that for sure.
I actually think that is the most under talked about. People talk about differentiating, build this big sales team, build this, build that. It's so rewarding to talk to somebody that has done work that's not like, I'm just interested in your business. It's more, I'm so interested that I spent weeks of my life trying to learn something that could be valuable to you. And I think founders love that, and particularly the founders that I love to work with love that, because it's they won't just be doing it with you. They'll be thinking about what are all the relationships in their life that they can learn something and that can add value to the company, which is ultimately what you want.
Do you find yourself creating process versus, meaning I'm a founder, you come to me saying I'm interested in investing, most founders will then talk to others because it's not fair to shareholders not to, versus reacting to process where deals are in play and you want to be part of that process?
Yeah, this has been such a fascinating change. I joke with some of the younger members of my team when we get access to things like data rooms now. I'm like, this used to be what we got all the time 7 or 8 years ago. There was a process. There was 2-3 weeks. But I think pretty much all of the most sought after companies, processes are created. So I think the ones that are most common are, I think most founders want to run some sort of competitive process, but not boil the ocean. They want to have a process with 2 or 3 partners and firms that they really trust, that they know understand their business, that they would be excited to work with. And at the growth stage, there is an important aspect. I think there is at every stage, but if you don't have a process, it's a lot of trust in determining valuation and market price. And if you have a couple of people, you can get some sort of pricing pressure in there, which, if I was a founder, I would do the same thing. And so that's how I see most of them go down, which is when we come to companies that we're excited about, we have done tons of work. We say, this is our investment thesis. This is everything we know about the business. We even tell them, this is what we think your metrics are going to be. And then it can be really confirmatory, that diligence process. It can happen in a couple of days because we've done all the work from the outside. We just need to make sure the data matches what we think it is. And you can get things done in just a couple of days, which I would say when I first started, again, which isn't that long ago, 8 or 9 years ago, it would be more like the 2 or 3 week process. You had done sector work before, but you hadn't deeply built your own financial model for a company where you hadn't seen a single piece of data. So that's how it's changed. You got to be ready to move super quickly, which means you have to be really focused.
So my sense is that was all like that until Halloween. I look at the world in holidays, and I feel Halloween, our world changed a bit.
I was Joe from The Facts of Life, so mine did change a little this Halloween, yes.
Very clever. That's very clever. But I think technically it was November 10th was the top.
Yes.
But has that changed, or have in your world yet, have you begun to see whether compression, names that were competitive are no longer there, just kind of the 90-day recap versus the really 9-year run-up we had to that with a lot of changes we can talk about. But I'd love to get just kind of real-time market pulse in your eyes.
Yeah, it's been fascinating. I mean, so I would say, I'm on the board of a couple public companies now, of companies that I've been involved with for a really long time that went public in the last year. And then, of course, lots within our portfolio that near term. So I would say the most significant impact is feeling what it's like to manage a public company right now, especially if you're a first-time CEO and you have gone public in the last 12 months. I mean, I don't know the exact fact, but the data point, but I think it's something like 70% of companies that IPO'd in the last 12 months are under their IPO price. I mean, that is so outrageous. Like, that's really for those that have been part of taking companies public or going, in investor roadshows, and that's a pretty rare time, and that's a lot of stress to be a CEO of those. And these are companies, because it's 70%, as you can imagine, most of those companies have hit their plan. It's not like they're going out and whiffing it. They have a very clear plan, if you're a well-run company, of what you're going to do the first 12 months. You got your beat and raise. These companies are hitting it, and they're still. We've seen massive multiple compression, as we know. We've seen a reset in the market. So that has taken a little bit more of my energy and just thinking about and trying to support those companies and think about those that are coming up next, just how you manage that transition. I think it takes a while for the private markets to fully understand it. I mean, I think what we've seen is a couple, I would call not like panic raises, but like, holy shit, this might, sorry, up front.
Please.
Sorry to Greg's wife. This might be, the party might be close to ending, but I hear there's a lot of dry powder. The companies I'm involved in, they're asked, like, should we raise a bunch more? So I think you see some of that activity. You see some, certainly when I talk to friends at crossover funds and stuff, when you're looking at public market data and private market data in the same day and all the time and studying these companies, which I do a lot, most growth stage investors do a lot, you think, man, this company better be really good in the private sector to pay anything close to these valuations, because there's some great deals in the public markets. I mean, these are companies that we all looked at, 6, 12, 24, 36 months ago that are trading at 50% the price. And so you definitely hear a lot of people scratching their head and trying to figure out, what is this going to mean? Maybe spending a little bit more time on the publics if it's a crossover fund. But I still think the most competitive deals are really competitive, and it'll be a couple more months where everybody really says, okay, is this the real new reset? For things to maybe calm down and revert a little bit back to where they used to be. So
do you kind of build it? Do you think what I call the new breed of growth, from durable to addition to D1 to Code 2, Insight, Tiger, you think they're going public company shopping right now because of the fact that you could get the same company you loved 12 months ago for 50% off?
I know they're going public company shopping. I don't know, the proportion, but when I talk to them, and I know it really looks like, I mean, if you have conviction in a lot of these public companies, they're 50% off, a lot of them, so from where people were buying in just 12 months ago. So whether it means that how much they'll pull out of privates, or divert focus, I think nobody totally knows. I mean, this was the same cycle that went in the opposite direction, 7-10 years ago, when they saw, hey, all the value is accumulating in the private sector. Companies are just waiting to go public. Many years later, we got to go there. And all I know is they're very analytical.
Right.
So I would expect over time, smart analytical people will go where they see the best returns.
And does that mean you get more aggressive because you have a lane that has a little less traffic in it? Or do you think you keep doing what you do?
Yeah, I always look at it as like, I think growth investing will be competitive forever in the future, and it should be, because first of all, entrepreneurs deserve like a great product, which is capital at a reasonable price and partners who are going to work really hard for them. And, when you look back and think, gosh, investments you could have made 10 years ago, and how well they've done, I think it's hard to see a path back to that. I think that so many of the trends that are just so massive that we all see compounding into just gigantic companies. Look at the cloud infrastructure growth rates last quarter. It's like astounding. Look at digital transformation, stuff in automation. It's just, I think that the secret's out enough, and there's enough just massive companies that it will always be competitive. last couple of years, the best companies, I mean, you could be competing against, well, certainly there's like 50 firms trying to get in. You're seriously competing against a handful. So in the end, it's probably the same because it's only a handful that are going to get a chance to win the very best companies. And I don't think that competition will go away.
So last question, and this, like I said, we could go all day, but we talk a lot in the early stage about trying to be slightly contrarian.
Yeah.
And that if everyone's over here, you're too late, it's time to go over here. Does that same mentality work at the growth stage? Like, can you afford to be a quote unquote contrarian? Or is there too much information and perfect information that you really know the great companies and the not great companies? How do you look at navigating that in today's market?
Yeah, I mean, I think there is always room for both. And I think at the growth stage, I think there are always a handful of companies every year that, it's a consensus view that these things are just massive. And it's really about competitively, like, how do you try to win those deals and be the most value-added partner to that company? But there are always, that's a small handful. I think what's happened in this market is those small handful, it's often the same people. You have to be very, very good to win those deals and great partners and have CEOs just pounding the table saying, you want to work with this person, to the entrepreneur like raising. And then you have a bunch in between that aren't that contrarian that, there's been a lot of money chasing. So where I find contrarian, we were talking about this a little before, is like sectors go a little in and out of popularity. I did a lot of fintech invested in Stripe and Credit Karma and Gusto and a bunch of these like 6-7 years ago.
Did Stripe work?
Stripe is okay. We'll see. Yeah, that's good. So I think, that then is like everybody's doing that. So I spent the last year and a half in consumer, which Greg and I were chatting about. Did some companies I'm super excited about. There were a lot less people in consumer the last year and a half than there were in enterprise SaaS. So I think it's not always a company level. It's sometimes a sector level where things get heated or less crowded. But I think it's the same. If you want to invest in great companies, you're going to have to work super hard, and it's going to be really competitive. But that's kind of how it should be. And I think the other great news is there are so many great companies. I mean, when we used to build our growth models 5-6 years ago and be like, okay, if this turns out like Salesforce or something, it'll be a big winner. Now you can be like, there's like 50 cloud companies compounding at 50%, bottoms up models with much better like long-term unit economics. And it's it's exciting. So there's, where there's excitement, there's, you also have to work for it.
Great place to close. Thank you so much. Applause for Laela.
Thank you.
Thank you very much.
Thank you, Greg.